Hi students, my name is Gopi Krishna. I am a practicing cost accountant. Today we are going to learn about internal reconstruction. Internal reconstruction deals about loss-making companies. When a company is running into losses continuously over a number of years, it is left with three options. First option, either it has to shut down its operations. We call it as a liquidation of a company. Second option, the company has to be sold to any other company. We call it as merging of companies or amalgamation of companies, external reconstruction. And the third option is the company's assets and liabilities have to be restated at a fair value, which is called as internal reconstruction. Normally, in case of other forms of a business like a sole proprietorship business or a partnership firm business, whatever losses incurred by the sole proprietorship firm business will be borne exclusively by the sole proprietors. Similarly, in case of a partnership firm business, whatever losses are incurred by the partnership firm business will be borne by all the partners at an agreed ratio. Now, the most important question is, can the same logic, can the same treatment be also applied to companies? The answer is no. Whatever losses are incurred by the company in the current year will be carried forward to the next year with an anticipation in the future years a profit might arise, and that profit can be utilized for offsetting the losses incurred in the current year. If everything goes well, it is fine. But if in the future year also, if you are making losses, then you are left with no option other than asking the equity shareholders, preference shareholders, debenture holders, sundry creditors and other creditors to contribute for the wiping out of accumulated losses of the company. Okay, so this process is called as an internal reconstruction. So you can exercise an internal reconstruction process if it is permitted by the articles of association of the company and if the court sanctions gives an order for undergoing the internal reconstruction process. Okay, so I will repeat, internal reconstruction can be done with the approval of the court and if permitted by the articles of association of a company. Internal reconstruction is nothing but taking contributions, asking contributions from the equity shareholders, preference shareholders, debenture holders, sundry creditors and other creditors to wipe out the accumulated losses of the company. Now, another important question is, we are saying that we need to take contributions from the shareholders and creditors to wipe out the losses of the company. What losses are you referring to? Are you talking about only the losses what we are seeing in the debit balance of P&L account? The answer is no. It is not only the losses what we are seeing in the debit balance of P&L account, but also the other losses which are represented in the form of various assets. I stated earlier that internal reconstruction means restating the assets and liabilities at a fair value. That means, take an example. Suppose on the asset side there is a plant and machinery whose written down value is 10 lakh of rupees. But when you are estimating the fair value under the internal reconstruction process, the fair value have been stated as 4 lakh of rupees. That means written down value is 10 lakhs as far as the balance sheet is concerned, but fair value is 4 lakhs. That means there is an amount of rupees 6 lakhs which needs to be wiped off as a loss. This have been arisen because of overcapitalization of assets. That means in the previous years there would have been an inadequate depreciation being provided for a plant and machinery. If an adequate depreciation to the extent of, an additional depreciation of 6 lakhs have been provided in the previous year's P&L account, your accumulated losses what we are seeing now in our balance sheet on the asset side would be on a higher side in our example by an amount of rupees 6 lakhs. Because of that inadequate depreciation, your assets are overcapitalized and the loss was also in the form of a fixed assets. Now, next important question is coming to intangible assets. Intangible assets like your patents, goodwill, trademarks, if they are really contributing to the growth of your enterprise, definitely you would have not made all these losses over a number of years, because their contribution was zero, literally zero. The patents, trademarks and goodwill are ineffective, uneconomical. You are making losses continuously over a number of years. So therefore these intangible assets also needs to be written off. That means the loss is also being represented in the form of intangible assets. Similarly, unamortized expenditure also needs to be written off. So therefore losses which needs to be written off by taking contributions from shareholders, debenture holders and creditors includes the debit balance of P&L account, unamortized expenditure, loss in the form of a fixed assets due to overcapitalization of fixed assets, and loss in the form of intangible assets. So therefore we will open a capital reduction account under this internal reconstruction process. So capital reduction account we are going to open. It is in the nature of a nominal account. That means all losses and expenditures will be debited to the capital reduction account, and all incomes and gains will be credited to the capital reduction account. So whatever contributions are made by the shareholders, debenture holders, sundry creditors and other creditors will be credited to the capital reduction account, and that amount will be utilized for wiping out of all these losses. So therefore losses, that is debit balance of P&L account, and the unamortized expenditures like your preliminary expenses etc., and losses due to overcapitalization of fixed assets, losses in the form of fixed assets and losses in the form of intangible assets will be debited to capital reduction account. So after wiping out all these losses, if any balance left in the capital reduction account will be transferred to capital reserve. This is how we have to prepare a capital reduction account and prepare the post reconstruction balance sheet as per the internal reconstruction problem. Okay, so let us go and start working out this problem on internal reconstruction. Let's do a problem on internal reconstruction. You have been given the balance sheet of A and Company Limited. Assets consist of fixed assets and current assets. Under fixed assets you have freehold property, plant, patent, goodwill, trade investments, and on current assets you have sundry debtors, stock, deferred advertising, debit balance of P&L account, and on the liability side, share capital you have cumulative preference shares, equity shares, debentures, accrued interest on debentures, and on current liabilities you have bank overdraft, creditors and directors loans. You have been given various adjustments for doing this problem relating to internal reconstruction. You are required to prepare a journal entries reflecting the above adjustments, and you have to prepare a balance sheet of a company after completion of this scheme. Okay, so let us do a problem on internal reconstruction. We will write down the journal entries reflecting the transactions to capital reduction account. So first adjustment, the preference shares should be written off ₹2.75 each, and equity shares ₹2 each. On the liability side, cumulative preference shares are to the extent of ₹4 lakhs of rupees, consisting of 4,000 cumulative preference shares of ₹100 each. So this ₹100 preference shares should be brought down to ₹75 each. That means it should be written off by ₹25 each. We are saying preference shares should be written off by ₹25 each, which means preference shareholders are contributing to the extent of ₹25 each. So that amount will be credited to the capital reduction account. So let us post down the entry. 6% cumulative preference shares of ₹100 each should be debited. By an amount of rupees, what is the total amount? 4 lakhs. By giving a credit, it should be brought down to ₹75 each. So preference share capital of ₹75 each should be credited. The amount is 75 into 4,000. It is 3 lakhs of rupees. and the difference 25 rupees 25 each into 4000 is 1 lakh. It should be credited to capital reduction account. Okay, so next, equity shares should be brought down to rupees 2 each. Equity shareholders consist of 75,000 equity shares of rupees 10 each. The total is 7,50,000. This equity share should be brought down to rupees 2 each. That means equity shareholders are contributing to the extent of rupees 8 each, which needs to be credited to capital reduction account. So let us post down the entry. So equity shares of rupees 10 each should be debited. How much is the amount? 7,50,000. It should be brought down to rupees 2 each. That means 2 into 75,000 will become 1,50,000. So equity share capital of rupees 2 each should be credited by 1,50,000, and the balance is capital reduction account. How much is the amount? 6 lakhs of rupees. Next adjustment of the preference shares dividends which are in arrears for 4 years, 3/4 is to be waived, and equity shares of rupees 2 each should be allotted for the remaining balance. That means preference shareholders, there is preference share capital of rupees 4 lakhs and 6% preference dividend, it should be 24,000. It is in arrears for a period of 4 years, which comes down to 96,000. 3/4 have been waived, and equity shares of rupees 2 each is given for the remaining balance. So therefore, preference dividend to the extent of rupees 24,000 should be paid by giving a debit to capital reduction account. So let us write down here, capital reduction account should be debited with 24,000 rupees to bank account, because to this extent we are paying to the preference shareholders. I will repeat here, preference share dividends are in arrears for 4 years. Preference share capital is 4 lakh of rupees into 6% is coming down to 24,000, which are in arrears for 4 years. So it is coming down to 96,000. 3/4 have been waived and only 1/4 is required to be paid. So that is why we are debiting to capital reduction account to the extent of rupees 24,000. Next entry, accrued interest on debentures is to be paid in cash. In the above adjustments, for the balance amount of 24,000, it is paid in the form of equity shares of rupees 2 each. It's not bank, it is equity share capital of rupees 2 each, which needs to be credited by giving a debit to capital reduction account. Thank you. Next, accrued interest on debentures should be paid by cash. So accrued interest 3,75,000 into 6% is 22,500. So that amount is paid by utilizing the cash. So write down a general entry. So accrued interest on debentures should be debited with 22,500 rupees by giving a credit to bank account. Next adjustment, debenture holders agree to take over freehold property. Book value of the book value is rupees 1 lakh at a valuation of rupees 1,20,000 in part payment of their holdings, and to provide cash of rupees 1,30,000 secured by a floating charge on company shares at an interest rate of 8% per annum. So debenture holders are agreeing to take over freehold property. The book value of the freehold property is 1 lakh, but they are agreeing to take at a valuation of rupees 1,20,000. So that means debenture holders 6% debentures. Their liability is getting settled partly, 6% debentures. Their liability is getting settled to the extent of 1,20,000. They are taking a freehold property whose book value is rupees 1 lakh for an amount of rupees 1,20,000. So to freehold property 1 lakh of rupees, and the balance should be credited to capital reduction account, 20,000. Next adjustment, and the debenture holders also agreed to provide additional cash of rupees 1,30,000 secured by a floating charge on company shares at interest rate of 8% per annum. So they have agreed to bring 1,30,000 if they were secured by a floating charge on company shares at interest rate of 8% per annum. So write down the entry: bank account, debit 1,30,000 to 8% debentures. $1,30,000. Next, patents, goodwill and deferred advertisement have to be written off. Stock also needs to be written off. Bad debts of rupees 68,500 also needs to be written off. So that means we have to debit capital reduction account. All intangible assets are now getting written off. So the total amount is coming down to 8,36,000, which needs to be written off by giving a debit to capital reduction account. We have discussed earlier, whatever contributions are made by the shareholders, debenture holders, sundry creditors and other creditors, it should be credited to capital reduction account because it is a nominal account. All incomes should be credited to capital reduction account. Similarly, all losses which needs to be written off should be debited to capital reduction account. So that is why all the intangible assets and the debit balance of P&L account and unamortized account are getting debited to capital reduction account for writing it off. Next adjustment, remaining freehold property is to be revalued at rupees 3,87,500. So total freehold property is 4,25,000. Out of 4,25,000, we know that in the fourth adjustment 1 lakh book value have been utilized for repayment of debentures partly. Now the balance left is 3,25,000. It has been revalued to 3,87,500. So there is a gain of 62,500 which needs to be credited to capital reduction account. Let us write down freehold property 62,500 to capital reduction account. Next adjustment, directors to accept settlement of their loans as to 90% thereof by allotment of equity shares of rupees 2 each and as to 5% in cash and balance 5% being waived. So directors loans is rupees 1 lakh. 90% should be cleared by allotting equity shares of rupees 2 each, and 5% should be paid in cash, and the balance 5% should be waived. So let us write down the entry. So director's loan account should be debited. How much is the amount? 1 lakh of rupees. It should be settled by equity shares of rupees 2 each to the extent of 90%, 90,000, and the balance 5% should be settled by cash. So to bank account, which comes down to 5,000, and the balance is to capital reduction account. How much? 5,000 rupees. Next adjustment. Trade investments are to be sold for rupees 1,40,000. So trade investments is 55,000. So this was sold for 1,40,000. So there is a gain of 85,000 which needs to be credited to capital reduction account. Let us write down the entry. So bank account 1,40,000 to trade investments. What is the book value? 55,000. And the difference should be credited to capital reduction account. How much? 85,000. Next adjustment, the last adjustment, there were capital commitments totaling rupees 2,50,000. These contracts are to be cancelled on payment of 5% of the contract price as a penalty. So there were capital commitments to the extent of 2,50,000, and these contracts should be cancelled by paying an amount of 5% on 2,50,000, which is coming down to 12,500, which should be debited to capital reduction account as we have to write off this expenditure. So let us post down the entry. Capital reduction account debit 12,500 to bank account. Ignore taxation and the cost of this game. So we have completed the posting of journal entries. We can now prepare respect to accounts like capital reduction account, bank account and other accounts by using these journal entries. So let us open a capital reduction account. So we know that all contributions made by the shareholders, debenture holders, creditors will be credited to the capital reduction account. As it is a nominal account, all gains should be posted to the credit of capital reduction account, and that credit should be utilized for writing off the losses. So therefore all the losses will be debited to capital reduction account, and any balance left in the capital reduction account shall be transferred to capital reserve account. So let us now post the entries into the capital reduction account. The totals are balanced equally, so there is no balance left in the capital reduction account. So therefore nothing will be transferred to capital reserve account. Now let us go and start preparing the balance sheet post reconstruction. The balance sheet of A&Co Limited and reduced as on 1st January 2017. So we are preparing the balance sheet post reconstruction. On the asset side, we have a freehold property. So let us go to the adjustments and balance sheet. As of 31st December 2016, the freehold property is 4,25,000. Debenture holders have agreed to take the freehold properties to the extent of 1,20,000 and the balance freehold property have been revalued at rupees 3,87,500. So let us write down freehold property as 3,87,500. Next, plant. The balance sheet, it is in the last year balance sheet, it is 50,000. There is no adjustments. So therefore 50,000 is the balance sheet post reconstruction. Patents, goodwill have been completely written off. So therefore their value will be nil after reconstruction. Next, traded investments. There are 55,000 pre-construction. All the investments have been sold for rupees 1,40,000. So therefore trade investments will be 0. On sundry debtors, the balance is pre-construction 4,85,000, sundry debtors 68,500. There is a provision for bad debts. So let us write down sundry debtors 4,85,000 and a provision for bad debts is 68,500, which is coming down to 4,16,500. Next, stock. Stock in the balance sheet is 4,25,000 and it has to be written off by rupees 65,000. It's coming down to 3,60,000. Next, deferred advertising and debit balance of P&L account have been completely written off. So therefore their value will be 0. Next is bank. We have opened a bank account utilizing the journal entries posted earlier. So whatever journal entries which we have posted earlier, if you are preparing a ledgers on the basis of journal entries, this is the bank account what we are getting. The balance carried down is 35,000. So the balance brought down post reconstruction is 35,000. So the balance sheet you have a bank overdraft of 1,95,000. That is balance brought down 1,95,000. All adjustments we have posted in this account. So balance brought down is 35,000, which needs to be posted on the asset side of the balance sheet. Next, going down to liability side, equity share capital. For equity share capital, earlier there was equity share capital to the extent of 7,50,000 consisting of rupees 10 each, but they have been brought down to rupees 2 each. This is what we have seen in the first adjustment. So we have opened an equity share capital account. So equity share capital has been, the adjustments have been posted. Equity share capital account rupees 2 have been prepared and the balance is 2,64,000, which needs to be credited, that is which needs to be posted on the liability side of balance sheet. So it consists of rupees 2 each. So therefore 1,32,000 equity shares existing after reconstruction. Similarly, preference shares used to be to the extent of 4 lakhs at a price of rupees 100 each, but now they have been brought down to rupees 75 each. So therefore we also opened an account for preference share capital and the balance which needs to be carried down post reconstruction is 3 lakhs of rupees. So therefore let us post 3 lakhs of rupees. So these have to be, these are at the rate of rupees 75. So 4,000 preference shares at rupees 75 is coming down to 3 lakhs. Coming to reserves, there is no reserves pre-construction and you also do not have any reserves which needs to be transferred. There is no balance left in capital reduction account when you prepare. So therefore the balance is 0. Now coming to debentures, 6% debentures, there used to be 3,75,000, but out of 3,75,000, 1,20,000 value of debentures have been utilized, have been sacrificed. So the balance is 2,55,000. So let us write down 6% debentures is 2,55,000. Now it has also been mentioned 8% debentures have been brought down at a value of rupees 1,30,000. So 8% debentures 1,30,000. And next, creditors, there is no adjustment on creditors, so 3 lakhs will be continued even after reconstruction. Directors loans have been completely wiped off, so therefore directors loan will become 0. So the totals are equally balanced, 12,49,000. So this is the balance sheet post reconstruction. I hope you understood this problem. Thank you very much. Have a good day.